What's up, legends? This is going to be a short introduction to what and who ICT is and the trading philosophy related to that. So, ICT is short for Inner Circle Trader. That's Michael Huddleston, the man who has cult like following all over social media and a bunch of haters as well. But by and large, ICT concepts are the single most prevalent trading philosophy out there, followed by individual traders. So, that's you and me. And algorithmic pricing of assets. And so the philosophy of ICT is such that there is not really a supply or demand factor in determining what the price of an asset is, but there's an algorithm that dictates where moves towards to fill orders. And smart money slash institutions. So futures is a hedging instrument. So that means it's used as protection to protect your holdings, right? If something is falling down, you will short that asset to make money in the short term to protect your long term holdings. And since over 90% of the volume in the futures market is by institutional investors, so it is always advisable to trade with smart money, aka in the direction of the smart money as compared to dumb money. So let's talk about algorithmic pricing of assets first, right? So this is how I convince myself to see that there is an algorithm, right? So on the left, you see micro Nasdaq futures contract, and on the right, you see the Nasdaq mini contract, right? So the one on the left, the micro contract, is a tenth of a mini. So for every 1 point movement on the Nasdaq, the micro contract would move by $2, while the Nasdaq will move by $20, right? So they are entirely different instruments. But as you can see in the chart here, so I have some lines marked out here. For example, you see 26,079, and then right here as well, same candle, same high, 26,079, right? Exact same price. 26,052 right here. This one is one tick off, right? So 26,052 instead of the 0.25. Right here, also 25,998.75 and 998.50, right? So basically the same thing, except there's sometimes differences within one tick. So this is the 15-minute chart on the MNQ and the NQ. And you can see here on top the volume on this 15-minute candle and the same 15-minute candle on NQ. So on the left, you see there's 46,000 contracts traded within this 15 minutes. And here, there's 14.73 thousand contracts traded, right? It would be logical if there were, let's say there were 10 contracts here and then 100 contracts here, right? 1:10, because micro Nasdaq is a tenth of NQ, but that's not how it works. And almost always they're within two ticks of each other. When I say almost, I mean 99.9% of the times, right? So three pillars of ICT. What are the three pillars? That's liquidity, time, and PD arrays. So PD arrays, PD means price delivery arrays, where price forms those arrays and then refers to it later. And it can also be referred to as premium and discount arrays, which also we'll take a look at later. So the market has two sides. There are the makers and there are the takers. So market makers are the smart money and takers are the dumb money, right? That's what they call them, in individual retail traders, right? So how do they make money and what's the difference between makers and takers? So let's say NQ is at 26,500. So the bid would be at 26,500.25. That's one tick higher. And the ask, which is a passive selling order, that would be at 26,499.25. So these large companies, these hedge funds, these liquidity providers, or these market makers have contracts available at all times to exchange hands for a fee. So for NQ, the mini Nasdaq, the commission is $2.75, right? To execute the trade you're looking for, right? Doesn't matter you lose money, or you make money, you're gonna have to pay the $2.75 contract commission per contract whenever you're in the market. You get in at the price you want, limit or market, and they probably get, out of the $2.75, they probably get a dollar or like $2, right? And the daily volume for Nasdaq for NQ is around 500 to 5,000 contracts every minute depending on the time of day, how busy it is, if there's any news, if there's any volatility, right? So that's what makers and takers mean. So on the left, you see a buy model. You see fair value gap displays, fair value gap displays, fair value gap displays, and then a bearish market maker sell model, right? So there's market maker buy model and then market maker sell model. Push down, fair value gap, push down, fair value gap, push down. So this is very easy to identify. I mean, visually, very easy to see. So now we come to AMD. That's accumulation, manipulation, and distribution. And inducement is also part of it, but it lies somewhere between accumulation and manipulation, right? I will link a video related to this, a short that I made recently. But to understand, there's 3 steps, right? So accumulation, price accumulates at a certain level or at a certain area. It manipulates. Manipulation means going in the opposite direction where it really wants to go. And then distribution to the intended direction of the price movement, right? And this is fractal. So this is happening on all time frames, even on a 1-minute chart, 15-second chart, 5-second chart, doesn't matter where it is and when it is. So on the 1-day chart, again, you see accumulation, and there's manipulation to the upside, and then there's the distribution. So this is expected to continue till at least this fair value gap or till this low. So how are you going to determine low and high probabilities, right? So that really depends on the time of day, and even more so, it depends on which day it is of the week, right? So generally it is focused around news. So let's say you have no news Monday, that would be a low probability setup. Any setups on that day would be low probability. But if there is news and you're trading before the news, that is also a very low probability setup. So I'll focus a little bit more on this in the time, in the module related to time that I'm going to be releasing. So I'm going to be releasing module for liquidity, time, and PD arrays, right? So be on the lookout for that. So just visually to explain to you what low probability is, both of these price actions are low probabilities. No obvious highs or lows being taken, no PD arrays being formed. I can probably see just one fair value gap right here, maybe one here, maybe one here. So they're scattered all over, but none of them are being respected, right? Even here, there's few fair value gaps, a nice IFVG setup right here, but there is no clear direction, there's no clear movement, right? So pattern traders will, I think it's called a flag or of some sort, but all this is consolidation at a time of day or at a time of week where it is accumulating, right? So after this comes the big move, so you might as well just wait for that. High probability. So I showed you the market maker buy model and the market maker sell model. Those would be higher probability if you see them unfolding. But if not, so this is another high probability setup. Very obvious, right? Bullish fair value gap trades only into the body of this fair value gap, doesn't even close inside, pushes up. This one, again, push up right here. There is a bearish fair value gap, but gets instantly inversed, right? So continuation of the buy model. So this is a higher probability condition. However, this is also a high probability conditions, but a bearish one, right? So push down, bullish fair value gap, back to the first fair value gap in the leg, push down, fair value gap, push back up, touch, so on and so forth, right? So it's very obvious which PD arrays it is referring to. So you want to hold out and wait for the higher probability days and the high probability times to take your trades. So essentially, the core focus of ICT is algorithmic signatures. So fair value gaps, order blocks, they're all PD arrays focused around liquidity, right? So algorithmic signatures, price is always moving for liquidity and squeezing. When I say squeezing, that means anytime price is moving towards a direction, which means it is not consolidating, it is hurting either the buyers or the sellers on a different time frame, right? So you need to be smart enough to recognize that. And as always, time of day, time of month, and time of the week is very, very important. It's even more important than price actually, right? You don't want to look at the price, you always want to look what's on the chart and what's on the PD arrays, right? So that's all for now. Peace to the Middle East, baby.